Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. Chairman Jerome Powell of the Federal Reserve left us in no doubt at last night's press conference that with inflation running at a 40-year high, it is for him enemy number one. That creates three key problems for investors. First of all, of course, it means tighter monetary policy ahead. Traders are betting on up to 5 rate rises this year. We're a bit more modest, thinking of 3, but add in balance sheet runoff or taper mid-year, and it's a very different monetary backdrop. Secondly, of course, rising inflation crimps consumer spending power, and this hits growth. We've already seen the IMF beginning to dial back growth numbers in China and the US for 2022. Thirdly and finally, as we look around the world, there are some unique geopolitical challenges, particularly Ukraine-Russia. And this is putting upward pressure on energy prices, oil in particular, and this is fueling inflationary concerns and making central bankers even more nervous. Wrap that all together, we have to ask the question for asset prices is the party over? Does a different monetary backdrop mean a very different outcome for investors? This is what we'll be looking at in the slides ahead and asking what it means for your portfolio. So let's begin by looking at the impact of those price rises in terms of the UK inflation index. I've showed in the left-hand panel the UK CPI rising at 5.4%. We expect that to trend up into the low 7s in the months ahead. But look at the breakdown. That big green bar, services, that's utility prices. The big red bar, that's transport, that's oil prices. Worryingly, that yellow bar that's beginning to expand is food prices. On the international stage, pricing pressure is equally evident. I've indexed 3 indicators at 100 on the eve of COVID and see where they are today. The Harper-Peterson Global Shipping Index up almost 4-fold. Brent crude oil prices up 36%. The Economist Food Price Index up 33%. None of those indicators showing any signs of serious moderation. This, of course, is going to trigger a monetary response, as we heard earlier. On the left-hand panel, I've shown the trajectory that we see for US rate rises, topping out in late 2023-24 at around about 2.5%. But a much faster ascent than we saw in 2017, last time the Federal Reserve tightened. They paused for a whole year at one point. We don't see anything like it this time round. On the right-hand side too, you can see that the rundown of the balance sheet is going to be much more dramatic than what President Janet Yellen had to face back in 2018-19. A reduction of somewhere around $2 trillion from the Fed's bloated holdings of US Treasuries, and that's going to be impactful for financial markets. Janet Yellen called it watching paint dry. I think it's going to be rather more dramatic this time around. Secondly, of course, we're doing this tightening of monetary policy at a time of excessive valuations across many assets. I've shown on the left-hand side the forward PE for the Global Equity Index in blue at 19.1 times, up substantially from its pre-crisis level. But look how much we've inflated the PE of business services and global technology, the, if you like, COVID winners from lockdown. And you can see at 30 times and 29 times, those multiples are up by almost a third from pre-COVID levels. On the right-hand side, you can look at it another way. I've shown the famous Shiller CAPE index. That's a cyclically adjusted PE index, often regarded as the most accurate measure of market valuations. At 39.6, that's not far off the peaks in valuation we saw on the eve of the 99 technology crisis. That's already had effect on some high or frothy asset prices. You can see on the left-hand side the ARC FinTech Innovation Index, that's small cap tech, coming down sharply in the US. The FANG index beginning to correct dramatically relative to the S&P 500. On the right side, I've shown the continuing decline in crypto assets, both Bitcoin and Ethereum, as they come back down to earth. Thirdly and finally, we're doing this tightening exercise at a point of maximum geopolitical tension around the world. In the chart from the Council on Foreign Relations, I've shown in red all the regions of the world that are in what they call Tier 1 conflicts. The big red shading over all the NATO countries in conflict with Russia over Ukraine, Turkey, Syria, Venezuela, Afghanistan, China, Taiwan, North Korea. You can see the broad message. And this, of course, is pushing up energy and commodity prices at exactly the time when inflation is its most potent in terms of central bank response. So what does this mean for our policy? Well, it means we are getting a little more cautious. We don't think alone that a tightening cycle will kill the entire bull market, but we do think it's going to make it much more dangerous for high-risk investment assets. That means we're taking our equity exposure back to neutral, we're deploying portfolio insurance, and particularly we have a strong overlay of quality and visibility and dividend growth in our equity selection. We've also lifted our uncorrelated alternatives to overweight to give us some protection, and as you can see there, holding a precautionary position in cash. Well, I hope that's helpful. The party isn't altogether over, but definitely we're entering more cautious times. Thank you so much.